Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from Jordan, the mining stock monkey. And we'll put a link to the mining stock monkey down below so you can follow along with his analysis on his YouTube site, but also he has a subscription service where he covers the mining stocks and his unique form of due diligence for subscribers. So we'll get into that a little bit later. But Jordan, man, it's been a while since we've had you on the show. We last talked last summer, and so we need to get an update. But I saw on your channel, on your YouTube site, that you had a video out, The Truth About Gold Stocks in 2025. And in this, you lay out some of the things you learned by just looking at a wide swath of the producers and some of the trends you noticed in price action and which metrics were moving the needle. I thought that might be a fun place to start just because we saw a lot of earnings reports just come in from Q4. We saw the year wrap up from last year now financially. What trends are you seeing as far as gold stocks for 2025?
Yeah, thanks for having me on, Shad. The idea behind that video is, well, I was seeing a lot of people thinking about what's moving some stocks while other stocks aren't moving at all. And there was this idea, oh, well, it's only the high margin producers that are moving, or it's only those in safe jurisdictions or something like that. So my goal with that was to dig into a bunch of different companies and figure out why some gold stocks had gone way up over the past year while others hadn't moved at all. And what I found is that it could all be answered by looking at the financials. Even though I hate this metric, any company that increased EBITDA dramatically over the past year saw their stock price increase a lot, assuming their debt didn't go way up and assuming their share count didn't go way up. It was so close. Like there were very, very few exceptions. And almost every company that saw a significant increase in EBITDA or even a significant increase in operating profit saw their share price go up a lot.
Well, now in that kind of an environment, you would expect maybe jurisdiction to play a bigger role or the growth of their assets or if they made some key transactions. Did you see these metrics being primary and that all those other things were secondary then?
From my research, in most cases, jurisdiction did not matter. And it did not matter if a company was a high-cost producer or a low-cost producer. What mattered is, are they making way more money now than they were a year ago? And if the answer to that question was yes, their stock price went way up, assuming, again, their share count and debt stayed about the same. Now, there were cases in which jurisdiction did matter, like, for example, those with exposure to Mali, those to get hurt. But also, those companies with exposure to Mali had big payments to the Malian government. So that affected how much money they made. So again, a big part of that was it went down to, did they make more money now than before? Like, for example, B2Gold is a company I follow very closely. And the amount of money they were making actually went down over the last year. And no surprise that their stock is down a little bit. And also, jurisdiction did matter when a company had their primary exposure to Canada. Those did see a little bit of a re-rate higher compared to what their EBITDA did over the past year or compared to what their operating income did over the past year.
Well, another observation on a different video you made when you were looking back at last year was that there were certain times where companies actually had a higher valuation than you were expecting, maybe earlier in the year, just because investors were willing to pay more for them. One of the examples you brought up, people of the show will be familiar with, and that was the Gato Silver trajectory that they were on, and then they were eventually taken over by First Majestic. I'd love you to maybe break that down because I think it was an interesting learning lesson you got from last year, and it also speaks to how investor sentiment and sometimes just a frothy herd mentality can push companies higher than we expect.
Yeah, I've been looking for quality silver plays at a reasonable price, and I've had a really hard time finding them. So earlier in the year, last year in 2024, I did a deep dive into Gato Silver, and I came away from that research thinking, okay, this is a great company. They're making a lot of money, and their deposit is probably going to grow. But right now they're trading at, I forget what it was. It was something like 1.3 times NAV. I was like, no, I think it's too expensive. So it was, I forget, $7 a share or something. And I was like, no, I think it's too expensive here. If I own this, I would sell. And then the stock price over the course of the year just kept going up and up and up. And then it got taken out by, I think it was First Majestic Silver for I forget, $14 or something like that. So it went from a company that I thought was already expensive at $7, and then it doubled from there. So it just goes to show you how much certain investors are willing to pay for quality silver exposure. Now, in the First Majestic takeout of that, I do think First Majestic shares were trading at a pretty significant premium to NAV as well. So that helps them pay more for it because they're not using dollars, they're using their shares as currency.
Yeah, it's a great point, and it's nice when companies can do that. They can use their paper for the acquisition, and if they've got an inflated share price, that helps them make the acquisition and justify it. But I guess speaking of M&A, there's another high-profile deal I'd like to maybe get you to weigh in on. We just saw announced earlier this week that Equinox Gold is acquiring Calibre Mining. We've talked a little bit about this on the show already. I'm biased in the sense that I have shares in both companies, so I'm conflicted in that I really don't know how I feel about this transaction. But Jordan, I'd love you to get you to weigh in it because you look at these companies closely. I know you've done a deep dive in Equinox previous to this in a video. What did you think about this merger between Equinox and Calibre?
I love it for both companies. Looking at online message boards and things like that, I see there's a lot of Calibre shareholders who seem to be unhappy with it. And I think a big reason for that is they own the company hoping for a big re-rate as Calibre's new Valentine mine came online in Mexico. And yeah, in the merger, they're going to get less of a re-rate from that mine pouring first gold, reaching commercial production, reaching nameplate capacity. However, Equinox has their Greenstone mine that's ramping up right now. This is a big new mine in Canada. They recently hit commercial production, but each quarter it's contributing more and more to the company's balance sheet, and it's making the company more and more money every quarter. So Calibre shareholders are going to get access to that re-rate as the quarters progress. So Calibre shareholders are going to get the benefit of Greenstone helping Equinox to re-rate. And then at the time that that mine is getting to full capacity, then I think we're going to start seeing the benefit from Valentine coming online and that re-rating as that ramps up to full production. So I like that a lot. I've also seen a lot of pushback from Calibre shareholders saying that they don't like this because Equinox has a lot of debt. And that's true. Equinox does have a lot of debt. But based on my analysis of the balance sheets, well, is I think Calibre's balance sheet is worse than Equinox. And I think Calibre is in real danger of needing another major financing here. So Calibre has $265 million of current liabilities. That's liabilities due in the next 12 months. And they have $131 million in cash. So between their cash and current liabilities, there's a $134 million gap there. Now, they do have other current assets, but they're still spending money finish building the Valentine mine. And if there's delays in that, or if there's problems with the ramp up, we could see another big raise from Calibre to complete that funding. So that really worries me with Calibre, but the combined company is much more financially sound.
Well, let me ask you on the Caliber side of things. I could see that being a going concern if they were going to have a delay in the mine for some reason being built, or if they had to come up with a big financing. Maybe they would have thought, hey, we'd be safer in a larger company. But from the other side of it, if I play devil's advocate as a Caliber shareholder, which I am, I was excited to see Valentine go into production because of the re-rating, as you mentioned. But I also know that some of that debt that they still owe, they're going to cover because they're cash flowing out of Nicaragua and Nevada pretty healthily. So they're still going to have revenues coming in next couple of quarters that would cover some of that debt due over the next 12 months. Has this bigger company, the combination of it, stolen some of the torque the companies would have had individually? Because both Greenstone and Valentine had promised for lowering costs for both companies, but as smaller companies, couldn't they have had more torque than as a combined larger company?
Probably, but I think the amount of safety Calibre shareholders get from this merger far outweighs any additional upside potential that they might have had without the merger. Because I think there's significantly more risk for Calibre shareholders without the merger. They have gold prepay starting very soon. They're going to have to start delivering ounces very soon before they even get first gold pour at Valentine. And we already have evidence to suggest that the Valentine mine build is a little bit delayed because they were saying first gold pour Q2 of 2025. Now they're saying first gold pour mid 2025.
Yeah, I saw a lot of people pick up on that comment in the chat rooms from the press release. Let me ask you another one. Ross Beatty, as the chair of Equinox, said he loves the transaction because it gives them access to what he called a flood of institutional money that wouldn't touch them as a smaller company, but at a company that has maybe closer to an $8 billion market cap, more liquidity, more production, near 1 million ounces, moving into the major zone. It gives them access to, he said, a new class of investors. Do you think that weighs into it all?
Oh, absolutely. One of the reasons why I like the combined company is because they're a bigger company. They're going to have more index fund exposure. They're going to have more, not just index fund, but also mutual funds. Because, well, there's a lot of investors out there who aren't able to buy those companies that don't have a big board listing in the U.S. But I think a benefit that a lot of people are overlooking is the savings from this deal, not just the combined G&A. That might result in, I don't know, about $17 million of savings, but also the combined company is going to have a much lower cost of capital. And I think between their savings, between G&A and a lower cost of capital, they're going to be saving about $40 million a year. That is a heck of a lot better than earning another $40 million a year in revenue, because that is going straight to the bottom line. That is 100% margins. So that's a big deal that I do not think should be overlooked. But I think they're going to get a higher multiple in the market. Their two main flagship projects are their main flagship mines are both going to be in Canada. So I think they'll probably get a Canada premium for that as well. There's substantially more liquidity for Calibre shareholders. There's a lot less risk in terms of ramp up for Calibre. And then Calibre shareholders also get exposure to this huge potential catalyst in Equinox's Los Filos mine. So Los Filos is totally excluded from 2025 guidance because they need to reach an agreement with the three local communities there. Two of these local communities have already signed on to a new agreement. But the reason why they need a new agreement is because that mine has made them very little money. However, they have a huge reserve base and a huge resource base there at Los Filos. And if they can spend a few $100 million building a new CIL plant and drastically increase recoveries, well, then they're going to be able to turn that into about a 360,000 ounce per year low cost producer. But they're not going to make that investment unless they have long-term agreements with the local communities that ensures profitability. Now, I have reason to believe that they will come to an agreement. And that is because I went and did some digging to figure out what this local community was. So I live in Mexico. I speak the language. So I'm able to go in these Facebook groups, watch Spanish language videos. So what I did is I was able to find this video from Ejidal Assembly from this community that's the holdout. And they were saying that Equinox was offering a 2% royalty and they wanted a 4% royalty. And I believe this royalty would be shared amongst the three communities to the best of my understanding. So basically, this holdout community would get 1/3 of a 2% royalty if they sign on to this deal. And at $2,900 gold, with the mine producing 360,000 ounces a year in the future, that royalty for that community, if you break it out by the population of that community, that's about $7,000 a year per person. And this is in southern rural Mexico, where a very good job for the average person pays about $500 a month, about $6,000 a year for a very good job. So, and then each person is going to get an additional $7,000 a year. That's a gigantic economic incentive. And that doesn't even include the high-paying jobs that the mine is going to provide. So I think there's a huge economic incentive for that to move forward. And Calibre shareholders are going to have exposure to this re-rating if that happens. And that's going to be a very big deal.
Yeah, I think that's an interesting angle that Los Filos, there's that potential wild card upside factor, the upside surprise that nobody's even factoring into this deal and the production's not being factored in. But if they can do that CLI plant expansion, that could be a nice boon in both companies' feathers caps if they come together and that comes into fruition in the year to come. We'll know more. I know they're still trying to work it out with the labor unions and try to come out with some agreements, but those local communities on the royalty, that would be a big advantage to that whole community to say yes to it versus saying no to it. And it brings up an interesting point here, Jordan, on royalties in general being so valuable. I think royalties are some of the most valuable assets that come out of the extractive industry, whether it's oil and gas companies or copper companies, or in this case, gold and silver companies. I know that you really like the royalty companies. I do as well, but give me some of the reasons why you like the business model, the royalty business model, and why you think it's at times even more advantageous than the individual risk you take on with a single mining company.
Yeah, well, most royalty companies are highly diversified, so that's great. They have really high margins, so that's good as well. There's less downside if the gold price goes down. And while in the short term there may be less upside, I think in the long term there's actually a lot more upside in the royalty companies than there is in a producer. Like, as evidence of this, go look at the biggest gold producers. Pull up like a 20-year chart of them. See what Barrick has done over the last 20 years. I don't know the exact number, but I'm guessing the stock has gone nowhere. I would guess the same about Newmont. Whereas you pull up a long-term chart of a royalty company or a streaming company, just pull up a long-term chart of Franco-Nevada, Royal Gold, Wheaton Precious Metals. That's a line basically straight up from the bottom left to the top right. Of course, there's ups and downs along the way, but they're companies that consistently earn more money per share in the long run. And the downturns can actually be a very great, or like a really good time for them to acquire great new assets because they tend to have very strong balance sheets. They have huge margins. So even when the gold price goes down, they're still making a ton of money and they typically have a lot of liquidity. So when the miners need the money the most in those downturns, they can come in there and make deals with those miners and scoop up great assets for a song. And that allows them to grow even more in the upturn.
Yeah, and a lot of times in a really tough capital market, like we've actually seen the last year or two for a lot of the juniors and even some of the majors trying to build projects or develop projects, the royalty companies have offered a better cost of capital than even the financial institutions have. So sometimes for some of these companies, it's actually a better deal. Now, the detractors, Jordan, would say, yeah, but the royalty company is stealing all the value from the individual mining stocks, and they're going to have that royalty forever. Most of them are not capped. So, what would you say about some people seeing royalty companies as sharks feeding on the mining industry?
I mean, when one of these juniors that needs financing does, like, let's say a stream with Wheaton Precious Metals, usually you see their internal rate of return go up quite a bit. Yes, it hurts long-term profitability of that mine, but it makes it a whole lot easier for that mine to get built in the first place. So, I mean, I don't see them as sharks. I mean, it's a free market, and the miners are going, or those developers are going to take the lowest cost of capital available to them. But something else I like about the royalty and streaming business model is basically the royalty or streamer pays an upfront payment for a certain percentage of that production from that mine. And as you said, it's typically uncapped and it typically covers a huge land package around the mine. So this comes with a lot of benefits. Sure, the rate of return from that initial investment might not look very good depending on the jurisdiction. It might only be a 6% return, or if it's a more risky jurisdiction, a 12 or 15% return. But that's assuming that the metals price never increases, that the mining company never finds more ounces, that the mining company never expands production, and that technology does not improve. But the reality is that when a new mine goes into production, the average mine produces for about 3 times longer than the initial feasibility study. So if the initial feasibility study said it's a 12-year mine life, that mine will probably produce for about 36 years on average. So that 7% return suddenly becomes a whole lot higher. And then over time, the price of the metal tends to go up. You look at a long-term price chart of gold, for example, again, that's a line from the bottom left of the chart to the top right of the chart. Over time, the price of the metals tend to go up quite a bit. And that is free upside for the royalty and streaming company. And then the mining company wants to make sure that the mine produces for as long as possible. So they try to discover a bunch more ounces. And then if they are successful in that, well, then it's pretty likely that they expand production at some time, which increases the NAV of the royalty or the stream. And then also, as time goes on, technology tends to improve. So resources that were not coverable or recoverable profitably when the mine was built, maybe with improving technology, they become profitable in the future. So you have all of those benefits that you get for free from owning a royalty or streaming company. So over time, they tend to provide very, very good returns. You still have to buy them at the right price. Like a few years ago, the royalty companies got super hot and they were pretty overvalued, in my opinion. And shareholders who bought in 21, they've suffered. So, I mean, as always, you need to buy the stock at the right price. And just because it's a royalty company, it doesn't mean you're automatically going to make money. But I think you have a much greater shot of getting good returns over time with royalty companies than with the miners.
Yeah, absolutely. And you bring up so many great points. I was kind of playing devil's advocate just to ask you about, how some people see them as a threat to the mining stocks, but really they're usually partners with so many operators and they're allowing mines to get built that wouldn't have gotten built on their own. I think every capital stack I've seen from a developer trying to build a mine over the last couple of years had a royalty or streaming component as part of it, along with the debt and the equity. And I also think that you made a great point about how a lot of these projects are looked at in the 10-year or maybe 15-year window that the economic study has laid out, but they almost always produce longer. They almost always have exploration upside that nobody was factoring in. And like you say with technology, maybe it brings in a component to bring in unminable ounces and turn them into mineable ounces. So a great business model. Are there any of the royalty companies that you think are looking at buying other royalty companies? We saw a wave of mergers a couple of years ago. It's been relatively quiet since then, but there's a lot of mid-tier or smaller royalty companies all nipping at the heels of the larger ones. Do you think we'll see more consolidation in this space?
I have no idea. I would love to see consolidation because what I view as the biggest drawback with a lot of these royalty companies is that their G&A is consuming way too big of a percentage of the money that they're bringing in. And I don't like that. So I would love to see consolidation to get that G&A down.
Yeah, and maybe just some larger portfolios that then attract a larger audience, just like the M&A discussion we were talking about with mining stocks. A bigger company going to get a better multiple. It's going to get more eyeballs following it. But you also
Yeah.
mentioned you live in Mexico and that you are there on the ground looking at some of these things. There's been a lot of chatter, Jordan, about the new administration that started in October of last year with Claudia Sheinbaum as president. There's a lot of optimism that Mexican stocks could get re-rated because they're thinking, hey, some of these permits are going to start dropping. And we have seen some permits getting issued on amendments or pushbacks, some of the easier permits to get the beginning of this year. So they're getting optimistic like they always do, Jordan, like, hey, this could be the year for Mexican stocks. As someone living in Mexico, how do you see the lay of the land there for mining stocks?
Well, I don't mind owning royalties or streams on a Mexican mine, or at least a producing Mexican mine. But the truth is, I'm not so bullish on the country, and it's not just the current president. It's like the society in Mexico. So, and it depends on where you're at in Mexico. So, I think companies with operations or development projects in northern Mexico, particularly those states that touch the US border, those tend to be much better states than mining or for mining than the southern states. And those people who live in the north tend to be more capitalist than those who live in the south. And as you get further south in Mexico, you you see more and more people who lean towards socialism and who have this idea that the best way for them to get ahead in life is for them to get more money from the government. And I don't think that's a very good route for them to go. But aside from that, I think The Mexican people are very, very proud. And there's this movement here in the country that Mexico is for Mexicans. And there's a lot of skepticism around foreign ownership of anything in the country. And the foreigners living here, even though they make up only a very small percent of the population, have been blamed for the rising prices. Now, this is visible in some parts of the country where you have a lot of Americans moving there, for example, to let's say just say Puerto Vallarta, and it pushes the real estate prices up. That absolutely happens in some small parts of the country. But from that happening, they've been able to blame foreigners for the wild increase in the prices here. And I think that is what's fueling this Mexico is for Mexicans movement. And the people of Mexico are very proud. The average person is very proud. They're very proud to be Mexican. But this also means that being proud means that they have this idea that they do not need foreigners' money to be successful. So there's this very widely held belief that they don't want foreign money here. So there's these things happening from a societal factor, but also the government is making it harder and harder for companies operating here to make a profit, and they're really squeezing the margins. But again, it depends a lot on where you're at. As I mentioned, northern states are better than southern states, and connections are everything. If the management team has connections with leadership in the state that they're in, well, then they're going to have a lot better chance of success.
Yeah, I think we see that where if you've got a good social license, good political ties in an area, especially those northern states that are more mining friendly, more capitalist, a lot of projects still can move forward. But yeah, some of the ones in the southern part of Mexico, some of those states a little bit tougher to operate and maybe tougher to get that social license. So definitely something we'll keep following along with here. Jordan, I kind of want to wrap up with just talking a little bit more about what you do for your subscribers and your service. When I see you put out videos, I notice a lot of them are deep dives into the financial side of things. I think you do a good job of doing research that isn't just surface layer, fast and dirty. It's deep dives. You look at a lot of interesting news and pull from other locations that most people don't do. But what do you think the main edge is for people that subscribe to the Mining Stock Monkey?
This is what I do full time. So you're basically getting what I learned from my hundreds and hundreds of hours of research into this. And I'm reading all of the proxy statements and quarterly statements and annual reports and all that stuff, and following things as closely as I can down to the local communities that the companies are operating in, like in the case of Equinox Gold with Los Filos. So basically, you're getting access to lots of that research. You're learning what I'm buying and selling with my own money and things like that. But if you're interested, if you like what I have to say, you could start with my free content on the Mining Stock Monkey YouTube channel, and you can look at the deep dives that I go into with the companies.
All right, fair enough. And we will put a link to that down below so people can follow along with your work. Man, it's always great talking, Jordan, and just getting your take on the markets, which companies have your attention. It was fun diving into what you're seeing as trends in 2025 in the gold stocks, the royalty companies, talking about the mega merger we just saw, the creating a new major, and also getting into the Mexican mining business. So lots covered in this one, and I'm sure we'll do this again, hopefully a little sooner than last time. And for those that want to follow along with Jordan's work, again, click on the link below. Jordan, looking forward to our next conversation.
Let's do it again soon.